Hey everyone, welcome in to another daily editorial here on the KE Report. I'm getting an update from Heliostar Metals, more of a recap, an overview of the company's transition here from an exploration company to a near-term gold producer. I am chatting with Charles Funk, the president and CEO of Heliostar Metals. I'm going to go back through some of this year, the financings, the debt package that the company has organized to move forward with the Ana Paula Project, but then also to complete the purchase of gold assets from Argonaut and that in turn transition to becoming a gold producer. Now, Heliostar Metals is traded on the TSX Venture Exchange under the symbol HSTR, on the OTCQX under the symbol HSTXF, and the Frankfurt Exchange under the symbol RGG1. Now, Charles, look, the stock has done very well, especially since September when the stock reached a low of 29 cents. It was trending higher all year, but when that point hit, this transformational acquisition, the stock has gone up, I believe, over 150% since that time. There's been some financings that the company has undertaken and that debt facility. Let's talk more big picture here, Charles, where I've heard from a number of junior companies still how hard it can be to raise money in this market. But I think it just goes to show here that you put together a good deal, and especially you make some acquisitions, some transformational acquisitions, the market will take notice. Just talk to us high level here about what the environment has been like for Heliostar Metals to raise this money and issue these debt facilities.
Yeah, thank you. It's sort of we're right in the moment and looking forward. It's interesting to hear you talk about the recent past. It has been, we're in the middle of a pretty significant transformation that I think leads to a much more valuable company, and it reminds me of a comment that I'd heard a few times, and it seems sort of prescient right now that in this business, whoever has the lowest cost of capital wins. And so there's times when you're advancing projects from an exploration or advanced development stage where you've got a relatively low cost of capital. There's lots of liquidity, everyone's looking to get exposure, and you can go ahead. And there's times where the market's really tough. And you want to use those times, if you can, to leapfrog into more advanced opportunities that ultimately give you a lower cost of capital going forward. And so for us, when things were tough and the market was really washed out, we went and got much more advanced projects that just weren't valued either by the market or by the companies that owned them. And that set us up for the situation where we are now with production in a market where people are beginning to value gold equities again.
All right, Charles, let's talk a little bit more about the financings and debt facility then. The most recent financing closed this month, $6 million. That is where Eric Sprott really upped his position. You had another financing in August that closed for just under $5 million, both of those in Canadian dollars. And then the debt facility for a total of $10 million US. That's two different deals that combine to that amount. Give us a lay of the land then in terms of how this money and the debt facilities are being used to advance Ana Paula and also close that Argonaut deal where you're purchasing those gold assets, please.
Yeah, so I think if you look at the inflection point where our stock started to move, it's when we put together the 10 million debt financing, 5 million on a working cap facility with a 9.4% interest rate, and another 5 million, which is effectively a bridge loan, which we intend to pay back in Q1 next year at a 15% interest rate. And so from that moment on, I think that's when the market recognized that we weren't issuing equity to acquire this project. And then as an investor, yes, the company could be creating value, but if you're always increasing the share count, you never really get ahead. So I think that was, no matter how many times we said it as a management team, the proof or the catalyst that convinced people that the only way they were going to get exposure to Heliostar was by buying in the market. And that's the power of having, cash flow generating assets with the production assets that we bought. The financing that we've just closed from Eric was a little bit different. It was very opportunistic in the sense that it was unsolicited by us as a company. I'll be honest, when I saw the half warrant, I was a bit, I thought we were post issuing half warrant or any sort of warrant structure financings. But it came from Eric, who'd been a significant supporter, was the only financier, was the only participant in the financing. We raised money at our 52-week high that we'd only traded at for a couple of hours to that point in time. And Eric's history and track record is that if he does exercise warrants, he's never sold stock into the market to do it. So on a net basis, we thought a stronger balance sheet would ultimately help our share price. And so we decided to accept the capital from Eric as well.
You mentioned that whole cost of capital. The companies with the lowest cost of capital, well, gives them a lot more freedom to advance assets and to even make these transformational acquisitions. Those debt facilities that you mentioned, it's a total of $10 million US, but you did initially have a facility for $20 million US. It was a gold linked debt facility. That all changed with that Argonaut deal and with, I believe, this cheaper cost of capital. So walk us through that decision to choose the smaller debt facility.
Yeah, and it also kind of ties into our news flow as well. For shareholders of Heliostar, we were extremely quiet for the first 6 months of this year. We don't put out news releases unless it's something that we believe we can deliver on. And so, sadly, and it did affect our share price, we were quiet because we told the market that we were going to raise the money, basically funded by the potential gold production of taking Ana Paula underground to complete the decline and mine a bulk sample. And it took us 4 months and a couple of false starts. We were nearly there in around PDAC time, and we had a sort of lead pulled, so we restarted and went down another pathway. And we ultimately delivered that, I think, in late May or early June, a 20 million financing that we effectively gave up the economics on 12,000 ounces of gold, an effective 23% interest rate as a single asset developer on our project, Ana Paula Project. And then, incredibly, it was actually 2 days after that landed on our desk that the opportunity to buy all of Argonaut's assets followed up. And so that meant we sort of put that on hold. We spent the next 2 to 3 months going through the due diligence, negotiating, and ultimately agreeing to purchase the Argonaut assets, which incidentally cancelled the $20 million debt that we owed Argonaut as well. And on the back of that, I'm now having production. So for those who know Heliostar, the transaction closes at the beginning of November, but the underlying business is operating for our benefit from mid-July, for our commercial benefit. And so access to production meant that the average interest rate is around 12% now. So almost half the cost of capital for being a producer than from being a developer over either side of the summer of this year.
So then, Charles, look, we've talked about a fair bit of money being raised and these debt facilities as you move closer to closing that Argonaut deal. And as we'll talk about some more of the catalysts coming up, how is the company sitting for cash? Will you need to go back to the market?
That's a dangerous question to ask because I can't tell exactly what the future looks like. But for running our business today, no, we do not need additional capital to run the business. We can't put production guidance out until the transaction closes at the end of this month, very early November. And I think that will demonstrate quite clearly that the operating mines are cash flow positive. And then we have plans to expand on that production with some stockpiles and a restart of the pit at La Colorada next year. And so to run our business, to continue to produce gold, we don't need capital. For some of the restarts of La Colorada and Ana Paula, we will need capital. There's the potential that we may not need equity to do that, a combination of debt, cash flow, or the fact that we have nearly 12 million Canadian of warrants in the money give us a lot of flexibility to say that even if we were to need equity next year, it would be a very, very small portion of our company. So the key takeaway, and I think one of the things that is helping us get an increased valuation, is the market knows that we're not coming back for equity financings.
All right, Charles, let's talk about these catalysts then. I have almost a dozen catalysts here that the company has coming to, I believe, just Q1 of next year. So, as you said, the company was pretty quiet in the early part of this year. Sounds like news is really going to pick up here. Take us through a bit of the roadmap in terms of catalysts in the near term, even just through the rest of this year, please.
Yeah, so I think in the short term, we'd promised that we will very shortly have drill results from the program we've restarted at Ana Paula. We think that could get bigger. But then I think where we truly get the valuation that I think we're heading towards, if you compare us to the peer group, is when we can talk plainly about production guidance and some project economics. So I think we get our true re-rating between November and January in the next few months. And the reason I say that is their transaction will close. We will put out the 2024 production guidance on the back of that, which, although it's late in the year, I think demonstrates has the potential to demonstrate that our assets are cash flow positive. Then at the beginning of next year, put out next year's production guidance. And I have said before that I think we might be able to surprise a few people who think they know these assets and what's possible. And then we'll demonstrate the economics with a PFS of La Colorada for the restart of the La Colorada pit. So then you can see on a piece of paper in front of you the amount of money that the company can make this year and next, and then that growth that initially comes from La Colorada and then ultimately from Ana Paula. We think we can grow to 150,000 ounces of annual production from La Colorada and Ana Paula over the next few years. So they're the big ones. There's lots more technical studies. There's lots more drill results that will come out. We've got assets that we think we're going to continue to grow that are going to come into production quickly. And I think demonstrating those economics in this gold price environment is going to be a pretty exciting thing to do.
So outside of that move to production and closing that deal with Argonaut for those gold assets, what sort of more capital intensive work does the company need to undertake through next year?
Yeah, so there's probably two major capex steps for us. One is at the middle of next year, we plan to restart the La Colorada pit. And effectively, it's permitted for expansion, but Argonaut stopped doing that sustaining stripping. I suspect it's as money needed to go to the Magino mine in Canada. That they basically, like a farmer stopped putting out fertilizer to make a bit more cash flow one year. But that needs to be then reinvested in the future, and we will do that. And ballpark somewhere in the 50 million US range for that. I think we could borrow the bulk of that as debt, so we probably need somewhere in the order of 10 million to come from either the cash flow from our operations or the warrants that I mentioned that are in the money, or potentially equity. And then at the end of next year, we plan to build phase one of Ana Paula, and that'll have a similar capex number. But in reality, a new build, we probably can't borrow quite as much. We might need another up to 20 million late next year. Again, that has the potential to come from cash flow, warrants, or equity. So when you look at our market cap, we're talking about sub 5% steps outside the debt portion of these financings. And I think that's one of the things that's proving attractive is these are, we're not giving up a third or a half of the company to bring on production online. That's not coming online in 3 to 5 years. It's coming online in 6 months to 2 years, and it's coming on with very manageable capital requirements.
So as you mentioned, that move with Ana Paula towards advancing that asset later on next year, if you do undertake those capital requirements, are there synergies between Ana Paula and these gold assets that you're purchasing from Argonaut?
The synergy is not so much geographical in the sense that they're at different ends of Mexico with our operating assets in Durango and Sonora and our development project in Guerrero. But in terms of teams who know how to operate in Mexico, sharing process engineers, mine plan teams, tax planning, there's synergies from that perspective in that we're a Mexican-focused company with a strong team that's very knowledgeable on how to operate in Mexico.
All right. So, Charles, I guess as people look at this company, like you said, a re-rating could be coming after some of these transactions close and a few of these catalysts hit. But as I said, this stock has been almost going straight up for a month and a half, almost 2 months now. In a way, that is re-rating, but in also another way, look, we have seen the market just become a lot friendlier to a wide range of resource companies. Heliostar was already out in front of that move as one of the higher quality ones. So how do investors value this company as these other catalysts come? You will now be a producer. What are the comparables we should put on it?
Yeah, I think there's a couple of ways to look at it. And there's three ways to look at it depending on how deep you want to dive in. The first one is if we deliver that, 100 by the end of 2026, 150 shortly after that, 1,000 ounces of annual production on what I believe will be high margin assets, you can look at the peer group of companies, and it's a much more valuable company than we are today. You can delve in a bit deeper and do some work on what you think the economics might be from La Colorada, Ana Paula, Cerro de Gallo, San Augustine, the development, operating and development projects in our portfolio. You can apply discounts to those, and I would argue that you come up with a significantly higher value than we are today. Or lastly, you can look simply at our peer group, companies that have quality development projects in Mexico. And I would, obviously I've got the history with Vizsla, but I'd throw out perhaps Go Gold or Prime in that category, and ourselves with Ana Paula. We don't have anywhere near the valuation of that peer group yet. We've got permits and production ahead of our peers. So I think there's sort of a range of metrics, whether you want to look down the production timeline or the development timeline. And I think those demonstrate for me that we will continue to re rate. And I think, as I said, being able to put those numbers down and release them to the market once the deal closes and we have the reports completed is going to be a fun period of time for us.
All right. Well, Charles, I'm seeing right now market cap for Heliostar Metals of just under $150 million Canadian. So you provided us with some examples that we can compare to other companies, other assets in Mexico. Again, Charles Funk, President and CEO of Heliostar Metals. I'll post a link to the company's website in the show notes. Be sure to click that link, read over some of the recent news, and send me any questions you have for Charles. Charles, thank you for this discussion today. I am glad that we could give a little recap of what the company's done this year.
Yeah, no, our motto is speed, grade, and growth, and we certainly love moving at the speed that we are, and we'll aim to continue doing that.